Well, thank you very much, Pierre, for this firework of arguments from your point of view, and it's pretty hard to take over this front after this wonderful speech. And, well, I think maybe it's should be good enough to put some things back to the basics and return to the essentials, if you're patient enough to hear that. And that's what I just want to try to do. But we will see that many arguments, we are very close together here in our positions, and so I must try to, yeah, it works, that's wonderful. Ladies and gentlemen, what is sustainable finance? What is sustainable finance? Just a minute. There we go. First, it's the aspects of steering of financial flows. The main objective of sustainable finance is to promote environmentally and socially friendly entrepreneurship. That means the management of assets in the real economy in accordance with the ESG doctrine, as we heard a few minutes before. However, in Germany, and as far as I know, in union law, there is no regulation at all to tell the managers how they should do investments in the real economy, and which kind of investments are bad or good for the environmental or social welfare. In general, that is not a matter of judgment. And the new sustainable finance doctrine, the sustainable finance doctrine does not change this. Sustainable finance, on the other hand, is about the legally controlled steering of financial flows, targeted at the financial investors because they make the final decision on the inflow of funds that can be used for business purposes. Financial investors are mainly the investment funds and insurance companies, which we call financial intermediaries between working capital and private assets. Their financial management practice is to be divided in two levels. On the first level, the regulation focuses on the investment behavior, so-called asset management or portfolio management. Secondly, on the second level, the distribution of financial products. That means the investment shares towards the investing public, and in financial service towards the individual investor is to be regulated. Here, financial service providers have the task of inducing private investors to acquire sustainable capital investments as far as possible. Let's have a look at steering strategies and effects. The legal steering of financial flows, which we call governance, the so-called governance, essentially takes place in the market for financial services. Steering in this context means, on the one hand, that the fund and insurance industries are restricted in doing their professional business in order to limit the range of their products. That means investment shares, especially investment shares offered on the financial markets. That means to concentrate strictly on doing business in sustainable financial products. On the other hand, steering may force them to expand the market range to provide additional, previously non-competitive financial products within their offerings. Affected by this are, firstly, the design freedom in professional asset management, what we call funding governance. Secondly, the marketing strategies and the distribution of financial products, in particular of investment shares, what we call product governance. And thirdly, the principle of best practice in the area of individual investment advice, what we call financial services governance. The Sustainable Finance Program gives capital market law a new meaning. In former times, allocative efficiency depended on the informed decisions of market participants acting for their own benefits. Now, allocative efficiency is driven by the settings of law, which are created by non-actors in the background, trying to, in some way, restrict the decentralized market power for the benefit of a sustainable common good or common welfare. Once the traditional goal of the greatest possible market transparency was open-ended, now it is a matter of achieving planning targets which are regulated in detail in the European taxonomy law, as we could hear a few minutes ago. In short, let me put it this way, conventional capital market law is intended to support the functions of decentralized market forces, whereas the sustainable finance program is aimed at supporting central market forces in a planned economy. After all, we can see that the collective interest of the common good ranks higher than the personal interests of individual investors. In Germany, that legal-driven conflict of objectives is often ignored. This really sounds amazing. So what's the reason? There are two explanations offered. Some put it simply that way, to say that sustainable finance products are generally more profitable than other financial products, which is definitely not true, as you can see on the example of shares in military industry, which tend to turn into blue chips currently by reason of the Ukraine war, and which are definitely not treated as sustainable up to now, as we heard from Pierre. Others say that private clients tend to be willing to put their own profit opportunities behind the interests of the common good. However, there is no empirical evidence on those theories. The European Regulation 1253 redefines investor interest with a key word I cite, sustainability preference, SP for short. Sustainability preference means, I cite once more, a client's or potential client's choice as to whether and, if so, to what extent one or more of the following financial instruments shall be integrated into his or her investment. End of citation. This obviously refers to the individual investor's interest. But, and this is a very interesting observation, this can be in favor of or against the consideration of so-called sustainability factors. And that means, as long as sustainable finance is based on the concrete individual SP, the law distinguishes between positive and negative SP. In my impression, this differentiation is supposed to weaken the steering function in favor of green financing. As I mentioned before, the regulation also refers to the SP of a potential client. Here, the concrete pre-contractual application reference is missing. Consequently, only an abstract supra-individual SP can be meant. It is in line with the principles of European law to limit the term to the variant of a positive SP, although this is not expressed in the text. The SP of a potential client is thus directed towards the ESG principles in the sense of the taxonomy. In contrast to the binary selection system of the taxonomy regulation, the definition of the SP in the new regulation does not allow for the qualification of an investment as predominantly ESG compliant or predominantly ESG harmful. Rather, All financial products are apparently to be assigned to a positive SP depending on the degree of intensity of their ESG reference. Once more, citation, to what extent, end of citation. This leads to the conclusion that even an abstract supra-individual SP concept is completely indifferent and does not allow a clear division to sustainable and non-sustainable financial products. Let's now have a look at an overall view of the steering program in sustainable finance. Let us try to go through the sequence of financing processes step by step. Newly issued shares or bonds are mostly subscribed by the financial intermediaries and packaged into portfolios. That's the meaning of the word funding. This is followed by the marketing of the newly issued fund shares or fund units. Marketing, from the legal point of view, is divided into the phase of preliminary planning of the sales operation in the customer business on the one hand, and the operational sales business as part of the financial service on the other hand. At this point, I would like to point out that during the phases of market planning in accordance with the ESG regulation, which we call product governance rules, there is no customer contact, so that there is no possibility at that point to explore the individual customer SP according to the Know Your Customer rules. The Know Your Customer rules as principle as part of the financial service governance rules. Product governance and financial service governance therefore follow complete different principles. We can start with this first level of portfolio management, as you can see here. First to the steering levels. The delegated regulation there under Article 1, Paragraph 6 prohibits fund managers in the investment business, inter alia, I cite, to trade in instruments as meeting a client's or potential client's sustainability preferences when those financial instruments do not meet those preferences. The regulation is meant to enhance and modify the best practice principles of proper portfolio management. Which kind of, in some way, designated client preferences that underlie this portfolio interest depends on the portfolio structure. The portfolio structure, again, is agreed in the investment conditions, which underlie the marketing story in order to offer running advertisement programs during the phase of fund distribution and must be approved by the Financial Supervisory Authority, BaFin in Germany. However, the regulation does not comment on the influence of SP on the portfolio structure. It is limited to trading. That's what in the text, trading. So according to union law, it remains open for the time being which kind of ESG framework will be available to asset managers in the future. The maximization of the sustainability factor in the portfolio on the basis of a predetermined SP, can lead to market restrictions if the legally underlying portfolio interest will be dominated by a non-profit ESG interest. Financial products that basically serve return interests without regard to ESG affinity of the portfolio companies will then be pushed out of the competition of fund providers. At this point, it is significant, again, that the customer preferences as set out in the new regulation mentioned above are always to be identified with ideal, that means positive SPs, by the asset managers, not financial servers, but asset managers. That again leads to the conclusion that a completely ESG non-compatible portfolio cannot, in principle, be sustainable. However, in my opinion, it shouldn't be expected that this steering system really works, because the legal concept of a positive SP is too colorful and indeterminate to tell us in operational details how the ideal ESG profile of an investment portfolio should look. Let's now turn to the second issue of the quantitative measurement of the sustainability factor. In German administration, the focus is largely on a specific ESG quota within the content statements and labels with which the investment fund is advertised to the investing public. The aim is not to create new portfolios containing ESG, but to check existing portfolios for compliance with the ESG substance specifically announced therein in order to combat greenwashing, as Pierre already mentioned. To this end, sustainability quotas of between 66% and 75% of the fund volume are required in Germany. This control approach is likely to limit the options of sector diversity and risk diversification in portfolio management. And this also shows a tendency towards market narrowing, which could lead to results that are against return-oriented portfolio interests, especially turnout and additional, what we call in German, Klumpenrisiko. I really don't know in English, maybe clump risks or so, I don't know, but we call it Klumpenrisiko. The conclusion is that European and German legislation has so far hardly developed any instruments that could support an effective steering system to guarantee sustainable fund management by investment companies in the sense of the sustainable finance doctrine. There is a lack of sufficiently concrete benchmarks for labeling sufficiently ESG compliant portfolios, both in qualitative and quantitative terms. Next one. Now to the aspects of fund distribution, product governance. This is played by the companies involved in the planning, implementation and control of the distribution of financial products, especially fund shares. The distribution of fund includes the opening of markets on the basis of pre-planned target markets for certain groups of clients, as well as the product monitoring following the release of the financial products for sale. According to the new Directive 1269, the determination of the target market requires the consideration of, I cite, any sustainability-related objectives, end of citation. The legal term sustainability preference used for fund management is not mentioned in the text of the directive. So the question will be, what are the factors or elements of the individual abstract preferences of the typical fund investor? To give an answer, we obviously need to make some differences between several groups of customers that have to be considered when different target markets are to be pre-planned. In Germany, a broad discussion has developed about what the typical interests of different groups of investors are. The traditional model of the rational investor, he talked about it, Homo economicus, has recently given way to the model of a Homo inferior. Sorry for this term, but that's what they say to name it. The model of a Homo inferior, who is inferior in every respect and who cannot count from 1 to 3, and this is completely helpless. It's economy stupid. That's what he doesn't really get. And who, according to the ideas of behavioral finance, is to be protected from himself by unconditional risk avoidance. Now we observe a third category is being added, the Homo ecologicus. The Homo ecologicus, who is oriented towards the common good. How to deal with this in the future is completely open question of crucial importance. To the steering criteria and consequences. The regulation of market opening and product monitoring is not specifically driven by the ESG doctrine. In the beginning of MiFID II, everyone knows what I mean with MiFID II, it was designed to eliminate dangerous financial products from the market. That means to consistently restrict the market, consistently. The new directive 1269 now changes the foundation of this control system in a spectacular way, in that sustainability and customer protection basically ranks higher than risk avoidance. There it is clearly regulated that financial products with a high risk factor can also be sold to unsuitable customers as long as ESG is promoted. The steering effect is not expressed here in the form of a market restriction, but rather in the opening of the market for risky speculative objects with context to ESG companies. I think this is one of the most exciting questions, what the effects of the traditional client protection in the product governance system will be. In my impression, the answer depends on how the practice will deal with the extremely broad legal definition of the term sustainability factors in the article, paragraph 24 of the SFDR. Overall, the preliminary result is that a new ESG-oriented product governance will hardly have a market-restricting steering effect. On the contrary, market openings for particularly risky and speculative financial products are to be expected. This seems to be a step in the wrong direction as far as the protection of the investing public from excessive risk to returns is concerned. Accordingly, all hope for a meaningful and effective steering system seems to rest on the third level, to which we will finally return, the financial service. Financial advisors with direct client contact in the sale of fund units will have to adjust their financial service to the individual SP of their clients in future according to the new delegated regulation 1253. A significant restriction should be mentioned here. In Germany, it has been clarified in principle that product governance does not exclude the options of an advisory-free order execution in the private client business, what we call execution only. This is even regulated by law. Sustainable finance is not likely to have changed anything in this respect. In any case, no such option has been advocated in Germany to date. However, it is unclear how such kind of safe harbor in the distribution system will harmonize with the rules on product monitoring. With regard to this, a small solution should be considered. And that means that the advisory company sends a warning note to the execution-only client if he purchases a financial product outside the previous defined target market. Market opening incentive effects are generated in the area of pre-contractual advice through recommendations. They are aimed at the acquisition of ESG-compatible financial products which otherwise would not be a successful blue-chip runner in terms of returns. The new rules of financial service governance in the new delegated regulation 1253 therefore deal exclusively with recommendations, not with the open-ended provision of information. Recommendations in favor of an optimal SP and against an inferior SP of the client have not been established in the system of financial service governance so far. Rather, the draft explanations state that sustainability factors, eyesight, should not dominate over a client's personal investment objectives. End of citation. If a negative SP is used as a basis, the subject of a recommendation could therefore be a completely taxonomy inconsistent financial security with high expected returns, as can currently be observed in investment in the arms industry by reason of the Ukraine war. To counter this, the new delegated regulation 1253 introduces the novel instrument of a subsequent SP adjustment. According to the German interpretation, this should enable and favor a course correction of the client. Accordingly, the advisory institution is apparently, I'm not quite certain about this, it's not a very, it has to be clarified, but in my impression, the advisory institution is to be obliged to reflect the client's first decision by adding certain concerns about the securities transaction from an ecological and social point of view in order to induce him to change his purchase decision in the spirit of sustainability. However, the discussion of that issue has only just begun. The counterpart of the market opening recommendation is a market closing issuing of warnings. Such advice has always been an integral part of the advisor's duties under the rules of conduct. However, they only have a market closing effect when they force profitable financial instruments out of trading because they are not sustainable enough. In the area of financial services governance, this results in a differentiated overall picture as far as classic individual advice in the private client business is concerned. The previous structures remain unchanged. In particular, the sustainable finance regulation do not provide for the steering of financial flows through the selective transmission of decision-relevant information. However, a noticeable influence on the investment behavior of private clients can be expected from the extended recommendation and information behavior of the advisory firms. They are suitable to establish ESG-compatible financial products in the market more than before and to push back ESG-incompatible financial products also against return interests of investors. So far, for this moment, thank you very much for your attention.